All right, good afternoon. If you guys can hear me, can someone just let me know in the chat? And then let me know that you can see the slides as well. Perfect, thank you. All right, so we'll wait a second here, see if anybody else is going to jump in, and then we'll move over and start going through the slides. And I guess just a reminder right now, anytime we do weekend data like this, there is a chance there could be some variations going into Monday. And so, I mean, this will be Tuesday because of the holiday, but when we get in on Tuesday, we will make updates to, front contract gaps, any variations in pricing. We'll do obviously a refresh on the data that we have in case some positional changes have been made. You know, it's pretty typical of us here. And then that way you get a fresh update in the morning before the trading session. So we're gonna move over and we'll just start going through this. I will monitor the chat, so feel free, throw any questions that you've got along the way as well. So right now we're gonna do an overview. We'll talk about the columns, somewhat of an abbreviated presentation from some of them that we've done in the past, but we'll hit the highlights just so that any new people have an understanding what the table is, why it was built, what it's built off of, and just general knowledge and understanding about it. And then we'll kind of get into Tuesday data, talk about where we are, talk about the above columns and, the above photo and then the below photo with the lines that we've put out yesterday as well. So really, when we look at this thing, it's going to be built on two things, delta exposure and gamma exposure. All right. Now, delta is going to be our base case. If you're not familiar with options trading and how that works, recommend take a look, do some reading. If you've got ChatGPT, have all sorts of conversations with that. Nothing that we share here isn't something that can't be found. All right, when having those conversations or Googling and talking to AI about it, it is straightforward once you get into it, but at first it can be a bit of an learning some of this stuff. All right, so delta exposure, very, very plain. All right, as time passes or price changes, delta does need to be hedged in order to maintain a neutral position, which is the goal of the market maker. Gamma exposure. All right, so this is going to be the rate of change of delta. All right, and so as price moves, all right, dealers have an opportunity to look at this to almost anticipate and hedge in advance of the exposure at various levels. And depending on the intensity, they're obviously going to change the volume in which they're hedging. A couple of key facts here just to remember, like long gamma, dealers are going to sell into rallies. They're going to buy into dips, standard behavior. But that behavior does flip when you get into short gamma. And short gamma, you're going to buy in, or they're going to buy into rallies and sell into dips. And this entire table was designed primarily to give you a cheat sheet on roughly what market makers would need to do as price moves around the SPX options chain. What you're seeing in front of you is just a snapshot from our local levels. You've got your three starting columns, which is really going to be, the SPX complex tickers that we pay attention to here. There are others, but these are really the primaries and the ones that we've built this table around. So SPY, ES and MES, and that'll be the front contract pricing, which we'll update every morning based on what that gap is going to be. SPY is also going to be a calculation. So there is rough math to say, hey, if you divided SPX by 10, you're going to end up with SPY, but we know that's not exactly true. There is a bit of a variation. It's about 0.035 to 0.040 on average. And so, we'll update that as needed, but really this just kind of gives you a great idea along the chain where you're going to see very specific behaviors in terms of hedging. And then under the strike column, those are going to be all your SPX strikes. This table was originally built specific for SPX options and the SPX option chain. And so everything that you're seeing is going to be data derived from that specifically. We've included ES or MES and then SPY, just so that traders who are trading futures or trading SPY as their primary have something as well that they can use, all of which are going to find confluence with this data as well. There will be slight variations as we know, but again, there's going to be quite a bit of confluence because they're all based on tracking and being on track with the same thing. The next 4 headings or columns, those are going to be our delta categories, okay? So hedge flow and strength, those were really the first 2 things that we had on this table. Strength being a derivative of delta exposure at the strike across a set number of expiries. And then hedge flow telling us just the general direction that market makers would need to hedge against that delta exposure. And so if it's short delta, they need to buy back delta, all right, or they need to buy futures in order to hedge that position. You know, the opposite of that is if they're long delta, they will need to sell. There are scenarios as price moves where they may do the opposite of that behavior. But as time passes, if nothing else is going on, that is the base case behavior. And so that's why we haven't included any additional buy sell trigger columns in this table. You know, in the future, we've looked at a couple of different ideas of what we can do to also showcase that additional behavior. But for now, I mean, this is kind of what it's going to be built on. Net flow. All right, so this column here is just going to tell you the difference between the updates. And so, you know, during the day, we're talking about updates every 10 minutes or so. You know, if we're doing like a morning report, then the difference between those two is likely to be, you know, between 6 a.m. one morning to 6 a.m. the next morning when I do the morning above and below and sort of morning update. So you might see some different values there, but that's all it really is to tell you. It's just there's a, you know, the variance or the net flow going into those strikes or out of those strikes, or the change of it as price changes as well. The color coding, may as well address that here. So, you know, pretty straightforward when it comes to the red and the blue, right? I mean, if it's red, then we're going much longer. If it's green, we're likely going shorter. Kind of lines up with your buy and your sell triggers there. Strength, though, if you're on the red, that means you're a stronger level of long delta. If you're orange, that's still long delta, just not as strong, right? So anything from 0 to about 1 is going to be coded that way. Then you flip over the other side of 0 and you're going to go into short delta. So yellow is going to be your first range from -0 down to -1. And then once you get to 1 and beyond, you're going to be highlighted green because, again, those are going to be positions of strength that we want to know about. When we talk about key levels report versus local levels, really the difference between those 2 reports is that the key levels report comes out once a day, single shot, and it's only going to show you the positions that have a delta strength of either 1 or greater or -1 and less than that. All right, so there is an additional column here. It's called flip. This is not a great photo for it, but flip will only generate if the forces in the hedge flow have changed from buy to sell or sell to buy. Okay, so if originally, say, strike 57.80 there is short delta, but hey, on the next update, that suddenly flips to long delta. There's some repositioning going on or something at that options level. What'll happen is a flip will generate, and that just indicates to you that, okay, something's changed right there. Does it matter in the micro ranges? Probably not as much, but when it comes to key levels, that would be significant. Moving forward, it's going to get into the gamma categories. All right, so pin is really just the direction of the GEX. When we originally put gamma on here, it was just pin and it was just strength. We didn't have above and below columns over there. I'll talk about what those mean in a minute. But pin for us is just to tell you, is it long GEX or is it short GEX? Right? If you go back to the slide before this on gamma exposure, you know, this is really why we put that in there, because long gamma tells you one dealer hedging behavior, short gamma is going to tell you a different dealer hedging behavior. And so by putting this on here was just a quick visual indication for us to mentally remind us, okay, something's going to behave a little different, you know, as you go through the various levels, especially when you transition from long into short gamma. The strength column is coded the exact same as your delta strength column, so all the color coding is going to align there. The last 2 columns here, though, is going to be the above and the below. What we have aimed to accomplish with above and below is to give you an indication based on the gamma positioning and based on where we are on the SPX chain, what the dealer would need to do based on gamma hedging, okay? And so the above column, you would be looking at that if the position you're going to evaluate is above spot. Yellow for us, okay, if you look at 56.85 in the middle of the screen, so yellow it's just going to tell you roughly where price is at the point in which we generated the update. And so the above column in this one here, we'd be looking at 56.85 and above. And you really wouldn't need to evaluate anything in the below column unless you were going to anticipate a move later on. And then same's true for the below column, right? From 56.85 below, everything in that below column is what matters currently, and anything in the above column doesn't necessarily matter. We've gone back and forth on whether we want to keep both or move it to a single column and do the math. For now, with the tool and how it's been generated, we're going to keep it as 2 columns just so you can help or it'll help you anticipate after something's happened, after prices moved. But just to kind of give you a visual, I mean, this is kind of what that would look like, okay? So if you wanted to look at it and know exactly what matters right now because price is at 56.85, this is kind of visually how you would want to look at that. In the future state of this tool, obviously, we will incorporate a slicer for it so that if you wanted to just see the one clean column of all of the behavior you're seeing right there, then we have that. If you want to maintain above and below, we'll have that as well. All right. Just doing a quick flip back. It doesn't look like anybody's got any questions so far, so we're going to keep rolling. Now, this table isn't going to change much. I will say, there's a lot of other reasons out there that the market can do what it wants, but this was designed to tell us when price enters an area, what should we anticipate based on market maker hedging dynamics. I encourage you, please go read, do whatever you can to figure out exactly what the mechanics look like. I have pinned a really great book on much more than just this topic, but it does a really good job going into the detail of it as well. You should be able to find that in the main chat pinned, and if not, it might be in the guides and walkthroughs. When it comes to that guides and walkthroughs, channel, we're going to continue to put in some scenarios there just to help you guys. But, as you're seeing it every single day, there's likely going to be some, some variances or behaviors that you see that you suddenly lock onto. And, there might be more than what we've been putting out there. I encourage you to look at it that way and make it your own for sure. I've said this in the past, we're here to help. We're here to give you guys something that you may not see every day. And if it can help you, do better risk management, time your entries on reversals or counter trades or whatever it is you're trying to do, that's really the space we want to be in, is just kind of give you something helpful that you can use to really time your entries and make a little bit more profit at the end of the day. So moving forward, we'll kind of get into the data for Tuesday. And what I've got here, I didn't put this in the above and below, but I mean, this would really be the base for what I would put out on a Reddit post for those people to see. And this is kind of just like where we are, right? Centered on the chain. What exactly is this position at this point? What should we worry about? When I look at this every single day and I start to do the drawings on it, I'm really looking for what I would call a cluster. I've had questions about that in the Discord before. Clusters for me, it's real simple. It's going to be an area where you're just going to have a large sequence or stacking of a certain behavior or position, okay? So if we looked at this right now, 5,800 to call it 5,825, but really 5,800 to 5,815, we got a lot of sell triggers in the hedge flow for the delta columns. You can see the strength there. Pretty strong red for long delta. That for me is a cluster. Whether it's above or it's below the current price of SPX, really doesn't matter. It's still a cluster of position to be aware of. When we talk about, what ends up happening in these things, if you're below a cluster like this and you've got gamma strength support that's aligned on the other side, typically you're going to see some capping and some counter trading opportunities. But I'll talk through kind of what those things mean as well. But really, yeah, with this table, it's all about looking for areas in which you're going to have confluence across both. Okay, so if delta and gamma agree on a topic, you're going to have greater strength in that area. If they don't agree, well, you're probably not going to have as much strength in that position, right? And so if we're looking at this right now, we can see, say, 5805. It says that we're long delta. It says the natural hedge for delta there is going to be to sell. And if we look over on the gamma side, in the above column, we've got a sell triggers there, but look at the strength. It's a little low, right? If you had Strength a little bit more significant, like 58.25. We got long delta there. We've got, long gamma as well. That's an area where we come up to it, you're probably going to see a little bit more strength in that positioning. The only thing I would caution you, based on what I'm seeing right now, is just the very tight mix of key levels. All right. So when we see these ranges of, and you could probably even call them a cluster of sort of yellow and orange positioning where, the delta that we're going to be hedging is actually a little bit lighter. Those are great spaces for price to hang out. Between 5770 to 5800, if we were to pop down into that area, I mean, that is just a great place for price to rotate around between those forces mechanically and really not break out into anything. But once you get below something like 5765, which is stacked with 5770 and also has stacking of long gamma on the other side, when we're below that, that's an area where you probably depend on it to come up, touch that area, likely curl and head back down. The only thing that I'd be looking for to give me a little bit more confidence would probably be more the trapdoor setup that we've talked about before. So the trapdoor setup for me is where we're going to see short gamma underneath, some strong delta hedging, some strong sell signals and long delta, and then maybe even some long gamma there. So don't really have any good examples of it right here. If 5870, was long delta and a sell signal, and then you see in the below column, you've just got a ton of stacked selling there. Let me just move my mouse here so you can see it. See this right here, right? That to me is like a golden trapdoor, right? If we came up here, even at 58.75, we come up here, if price pauses in this long gamma, long delta area, and then decides now mechanical forces are going to rotate in, maybe we got a little bit of selling pressure, what's going to happen? Well, all of this right here is going to help just influence pulling price lower, okay? So that's what I look for in a trapdoor. Otherwise, I'm looking for key levels, right? When we let's keep this moving over to the above and below so we can take a look at that. This right here is the above from what I put out yesterday. Let's start from the bottom. So right above 5800, your challenge for price for buyers is going to be trying to get by 58.15, 58.25, right? We've got some clustering of gamma saying, hey, we're going to sell in this area. We got some clustering of long delta here as well. If you look at the bias between 58.15 and 58.25, right? Of those three, you want to include 58.30, you could. Of those four strikes, you're longer delta than you are short. And so in this area here, you're probably going to get a little bit more counter trade opportunity and a little more price dampening. If you get a pop above that, though, and we get into this box, just this gigantic area here of short delta, I mean, this is an area where across time, dealers are going to be buying back into this and feeding any sort of rally. Look at the gamma on the side. Starting at what, 58.45 to 58.65, we get picked up into that area there. You've got time, and then you've got gamma hedging on your side to help pull us up towards that 58.75 strike, which right now on the gamma side isn't showing much strength. I'd have to go back and take a look at the expiries to see what's driving that, but that's your first counter trade opportunity there. It's got a bit of a a trapdoor setup with some long short gamma and these sell signals in the below column over here, right? So as price comes up, if it fails in this area here, it could very easily just kind of rotate back down, find its mechanical support, and just keep doing this rotation here until it finds a reason to break out. And a lot of that is what this is, right? If we're going to lean on passive mechanical support, what's going to happen? When Trump steps in and says, hey, here's the latest update on tariffs, whether it's good or it's bad, what do we know what's going to happen? Every level on the chain is going to get broken until that thing loses momentum. And when it loses momentum, what happens? all of your passive mechanical processes are going to stick back in and start controlling price action. And then you're going to get a lot more out of this table than you would trying to chase, the volatile opportunity that comes with his messages. Above this, then we've got a little bit of a rotation zone here. We've seen this before and talked about it. This is a great little spot here underneath 5,900. 5,900 does have a lot of long delta coming off on Friday this week. Be aware of that. Likely to roll and get repositioned, very similar location. But we've also got the JP Morgan caller strike here, 5905. That's going to help contain price as well as we come up to it. It's May, we're moving into June, so we got quarterly option expiration coming up on the 20th, as well as the end of the month there. And those things are all going to play a key role in what's going on in the next little bit. But this is a sticky area, okay? Between 58.75 and then trying to break through the mid 5900s is very sticky. I highlighted this, this short gamma area over here. It looks real nice and clean. If we get picked up into this area, you're not going to sit here and want to try and play rejections on 59.30 and counter on 59.50. Is it possible? Sure. But if this gets maintained in the short term, this is your path through those areas up to another strike that might have a little bit better confluence. The good news about short areas like this is if we pull real quickly through them, find an area up above where price action is going to slow and curl because you got long delta and long gamma working in our favor, well, then all of this becomes the trap door that you look for to help play that rotation to the downside. Moving down to what's below us. All right, I've marked out a few lines here. There's a lot more going on in this, than I've marked out. But I was really highlighting the fact that we've got some support. 57.50 is still a strong support level for us. The gap between 57.80 and 57.85, it kicks off a long line of stacked long gamma, which is going to be supportive, right? So, if you go back to that first slide I was talking about with long gamma, the dealer is going to sell into rallies, but they're going to buy into dips. And so as price dips down into this area, there may be some long delta to help support that move, but ultimately you're going to see some cushioning behavior here because as we're moving down, they're going to be met with this long gamma force. Further down below that, we do have another, what I would call a cluster. Now, sometimes with clusters, right, you're probably going to have some, some buy triggers in here, or maybe it's the opposite and it's a buy cluster and you got some sells in there. Look at the strength of them and determine if they're worth noting. Okay. And if they, if you've got something down here that aligns with what's going on in the gamma, pay attention to those and know that as price gets beneath them, it gets harder for you to go back up. There is one scenario that I will cover right now while I've got you about this situation. So if all you have is long gamma and we're beneath this area and we come up to it, yes, we're pretty much going to stop right here. We might have a little bit of a counter trade, but you have to understand that with long gamma means you've got buy support in the below column. So now every time that price tries to curl and go back down, it's actually supported. Okay. And so any amount of buying that comes into that just slowly pins us into these levels and will eventually start working its way through it, allowing for every strike to then almost become self-supporting of itself as we push our way through that long delta area. So it is possible to break through these things. Your ideal setup though is going to be a lot of red, and then a lot of red down here in the below column with some short gamma to help give you that trapdoor effect. All right, further down below the chain, you can see 5680 highlighted as well. So it's just another level where you're going to see that we've got buy support in the below column and you got short delta. There's not a lot of short delta in this section of the chain. It's actually pretty light and it's biased towards selling at this point. It just means that any rally is going to get faced with these mechanical forces over time. And as time passes, you're going to see more of a tilt and a draw down than you are going to see a squeeze or a push up. All right. So that's the table. I'll open it up if there's any questions over there. Feel free to ask them. Again, we're here to help. Nothing here is, secret sauce or anything like that. You could look this stuff up very easily. What we're trying to do here, though, is just kind of give you a cheat sheet to protect yourself while you're out there and do what you can to defend yourself with the market makers. They're not out there trying to get you, okay? They're out there trying to do their thing to provide liquidity and hedge themselves. And so, it's really just about understanding those forces and then doing what you can to hedge and manage your positions effectively. But if you're somebody who's always long, hopefully this kind of gives you an indication that when you come up to a certain level, could be a good time to exit because you're going to get hit with some mechanical forces that could bring you back down. Yes, that's correct. So the strike column, it is SPX options contracts, okay? And so the ES column, let me go back up here to, I guess, this here. So yeah, in the SPX or the strike column, this is all SPX options. So all of this data that we have in front of you, this entire table is being pulled from SPX options data. It's not your traditional open interest data. Instead, what we're pulling is positional data, which is actually going to tell you, our goal is to not make any assumptions here. Our goal is to give you, exactly what it is. And so you can likely calculate, I'm sure there's a way to do the open interest calculations to determine if something's short. But what we have, which is why we have very specific 10-minute updates, is positional data that's going to help you see whether it actually is a short position or is a long position. When it comes to the SPY column, that's a calculation. So we use the option strikes on SPX to create the table, and then we give you an estimation of what SPY or ES would be at those various levels. Well, that's a good question. Is there any other questions out there? All right, folks. Well, I appreciate you guys making time today. We plan to do more of these along the way. And so if you guys ever have questions, throw them in the chat. And, probably next weekend, we'll likely do another one if there's enough interest. But I think that's it for now. We'll see you guys on Tuesday.